Happy Friday, guys. It's the day before my birthday, and I'm sure you're happy of seeing the scenery, which means I've exited the gym. I'm exhausted, but since I told you about all these events that happen in May, and I've kind of haven't been able to go to the gym as much as I wanted to, I said, I'm not gonna wait till Monday to restart, even though I really didn't stop, but restart as in 5 days a week and just on fire. I said I'm gonna go today, and I'm probably gonna go tomorrow on my birthday and do legs, but I'm like, I'm gonna go today because you cannot lose the rhythm. So I went, and I'm so glad. Anyway, FPU, Financial Peace University, last night, it was awesome. It was about investing, and I've heard it so many times, and I listen to his show, so I hear the same advice over and over and over and over, so I understand it. But I do remember when I first heard it, it was kind of hard to grasp. So I'm going to do my best to explain it, and I kind of had that same feedback with the members last night, that they were like, oh, I'm a little bit confused. So let's see if, they say you learn something if you can teach it. So let's see if I can explain it in a way that you can understand it. So basically, what are the baby steps? Because right now we're talking about baby step number 4. So you cannot, or you should not, do this until you're in baby step number 4. So the first baby step, save $1,000 for emergencies. The second baby step, get out of debt. That's where we are right now. And in Jesus' name, we'll be out of debt in December. The third baby step is save your 3 to 6 months emergency fund so that you are protected when something happens, so that you don't need to get into debt, make matters worse to, pay for a medical event or for a lost job or whatever to survive. And I mean, honestly, think about it. If you were out of debt completely and you had 3 to 6 months saved, how much peace of mind would you have to make moves, to change jobs, to do stuff? Crazy, right? Okay, so baby step number 4, you save 15% of your income towards retirement. You put 15% of your income towards retirement. So there's a couple things here. One, the best accounts or the best arrangements in order to put your money into these things to protect it from taxes are the 401k and the IRAs, the Roth IRAs. And I'll explain the order that you should do it, like which ones, because they all have limits of how much money you can put in. So that's that. And then once they're in those tax favored arrangements, then what you do is you put the money into mutual funds. So we're going to cover those two sides. So one, your 15% towards retirement goes, firstly, the first most advantageous program to stick in your money for retirement is the 401k with match, if your company matches. If your company doesn't match, that goes straight to the Roth IRA. So, okay, let's cover them one at a time like this. Okay, so the first one is 401k plus match. Let's say your company matches 3%. That means if you put 3% in there, your company is going to give you 3% of your income of free money. You don't say no to free money. Even though you have to pay taxes to get your 401k when you retire, to get it out, to get the money out, hello, free money. The advantage of the free money you're going to get is way greater, especially if it's 50-50, right? Way greater than the tax you're going to have to pay to get the money out. So we'll use an example of a couple making $100,000 just for math purposes. So if your company matches 3%, as I was saying, you would put $3,000 into the 401k so that they match those $3,000 per year, those $6,000, right? Isn't that beautiful? So anyway, you put in your 3% in there, and what are you going to be putting of the total of your income? 15%, right? 15% of your income. That's what you're supposed to do in baby step 4, putting it into retirement for the rest of your life, okay? So that it could keep growing and you keep adding to it, okay? So Of that $15,000, you put in $3,000 into the 401k with match. Now the second tier is going to be the Roth IRA. You put this money after tax dollars, because the advantage of the Roth is if you put in the money after tax dollars, when you go to get it out 20, 30, 40 years from now, you don't pay taxes on it. And that advantage is insane. Let's say you fund a Roth IRA over the years and you end up putting $200,000, $300,000, $400,000 in it. You'll have several $1 million, $3, $4, $5, $6 million by the end of it, and you pull it out and you give this much to Uncle Sam. So that's the advantage. So in there, you will put in whatever the limit is for Roth IRA, and honestly, I think it's like $6,500 right now, but I don't have that what's called right in front of me. But if it is $6,500 per person per couple, so that would be times 2, 13,000. So bam, between the $3,000 in the 401k with match, and then the 13,000 and change limit for the Roth IRA, you've already put in your $15,000. Now, if you made more income, the remainder of your 15% of your income would go into a regular 401k. But the point of the order is the most advantageous for tax purposes, because a regular 401k, you put in the money pre-tax and you get taxed when you pull it out at retirement. But regardless, your dollars are growing in there, and you're going to have a ton of money by the end of it all. It doesn't matter the vehicle. It's just do it in order of most advantageous to have the most money at the end of the game. Now, going into what you do once your money is in there. So different companies that you work for offer different mutual funds you can invest your money into. So what you have to do is look at the how the mutual funds have performed in the last few years, several years, 10 years, however long they've been running, to decide if you're going to put your money in there. What you want to look for is 10% or better returns in history. So that's what you do. And basically, Dave Ramsey only suggests mutual funds, period. Index funds, too low rate of return. I think it's about 7%. So he only suggests mutual funds, and they are super diversified in itself, and then you diversify the mutual funds you select. So as I was saying, you have a little bit of a limited choice through your companies, but you just look at the track record. If you're going through Roth IRAs, not under a company, you have a choice of like 8,000 different mutual funds. Again, look at the track record over the past. How has it performed? Has it beat the index? That's how you pick it. And don't be overwhelmed. Like, once you're at this point, you can go on the Dave Ramsey website and look for endorsed local providers in order to find a SmartVestor Pro, in order to find somebody who invests like he says, and that will guide you to it. Because I know, again, it happened last night. There was confusion. There's like a lot of steps, a lot of information. And I mean, I don't even know if I'm explaining it in a way to understand fully, but at least it gets your mind going to look at where your money is, and even if it's just to encourage you to go get a SmartVestor Pro who invests as Dave Ramsey teaches. So you got mutual funds, but then you want to invest in 4 different types of mutual funds. One is growth, the next one is growth and income, the next one is aggressive growth, and the 4th one is international. The wild child of them all is the aggressive growth. That's the one that, goes sky high sometimes and then drops so low that you think you're losing all your money. But in the end of it all, you're probably going to get a rate of return on that one about 20%. And then some of the other ones are safer, a lower rate of return. But the point is, all together, and he suggests to 25% in each, a quarter in each. All together, you should be hitting the index. And the whole point of it is, this is for the long haul. If you look at it over the long haul, the index has had a return of 10, 11, 12, over the course of many years. You see I always say the Christian life is like the stock market. You have some dips, beep, beep, but it has an upward trend. Your money needs to ride along with that. So when you are investing for retirement, putting away 15% of your income every month into a retirement account, June, that's then invested into mutual funds. You gotta do it with a plan that is gonna be in there 5 years or longer. Because if not, you very well may take out your money and have less money than what you put in. You gotta be in it for the long haul. Even Warren Buffett, it's all about investing for the long haul. So the point of this is you put it in to not touch it till you retire, and you just let it right out. And I gotta tell you, there's fears of, you know, the potential loss of money and all these things, and it's like, people call into Dave's show all the time with the proof that this works. But it's the way he says how to do it, not reinventing the wheel, and it's for the long haul. Don't get shocked when your money goes down with the stock market, because it's gonna come back up, because it's the long haul. But anyway, hope this is a nutshell about it. I'll probably make more videos about it at some point. To make it clearer as it goes on, and especially once we're there. We're just not there yet. But yo, we are killing it to get out of debt this year, get our emergency fund, and we will be there. All right, have a good weekend.